On Wednesday, overnight bonds moved gradually lower as volume was starting to come back. Lower French inflation kicked off a rally in Europe on the heels of German improvement yesterday. Also, U.S. futures advanced with stocks as positive reports from China and data from Europe boosted risk appetite, with inflation peaking at 9.1% in June and sliding since. A recession is now the number one economic concern going into 2023. Of course, the experts have been talking about a recession for over a year, and B, recessions lead to lower rates. When businesses make less money due to lower consumer spending triggered by dwindling reserves, price pressures, and aggressive Fed, companies lay off workers and more people are hesitant to spend. Weak expectations or prior overinvesting also factor in the equation, with many firms feeling that large swaths of the economy could or already have experiencing worsening macro forces and a series of unknown variables, things like war, pandemic, energy prices, etc. There are also signs that the three big world economies, US, the EU, and China, are also slowing down simultaneously. Even countries that are not necessarily in recession, it would feel like a recession for hundreds of millions of people, but the argument against a major recession is strong. Gross domestic product is not negative. Many haven't cut their profit forecasts. Hiring remains surprisingly robust, and the unemployment rate is sitting near historical lows at 3.7%. If that resilience holds up and inflation continues to cool down, a soft landing could be in the making. I doubt it. The Fed also won't hike interest rates to the moon and has begun to set the foot off of the accelerator already, which could mean that somewhat of a slowdown is in store, but not one that slams on the brakes on the economy. And the rise of real income is likely to be a stronger force in 2023, along with supply chains being normal. That big chunk comes from robchrisman.com. The manufacturing economy did contract in December. According to the ISM Manufacturing Index, the index came in at 48.4, the lowest since the early days of the pandemic. If the index comes in above 50, it's expanding, while below, it's contracting. The prices index fell to 39.4, which is good news for inflation. Job openings were more or less unchanged in November, according to the JOLTS job openings report. The quits rate, which tends to be a predictive wage increases, ticked up as well. We also got Fed minutes. A few of the more important bullet points from the Fed minutes are: Fed minutes participants welcomed inflation drops in October, November, but concerned it would take substantially more evidence of progress to be confident in sustained downward path. Also, no participants anticipated that rate cuts would be appropriate in 2023, which is kind of abnormal. This was the most forceful language that we've heard regarding "Are we there yet?" song and dance, with respect to how good inflation reports it takes to change the narrative. Even Powell himself had previously said 2 consecutive reports opens the conversation, but that's not necessarily at odds with the minutes here, but it's definitely a takeaway for the markets, to be sure. On the topic of no cuts in 2023, the market disagrees, but this would be par for the course as far as the Fed's communications have been concerned. I think the Fed still thinks that they're going to make a soft landing. I don't. At the end of the day, we are up 19 basis points, ending at 100.8, which puts us right above that Fibonacci 50% retracement line at 100.758, and we have a real convergence of all kinds of lines here. So we have overhead support at 101.02, then we have floors at 100.607, 100.172, and then 99.845. So that should provide a little more stability, hopefully. We also got a great post from our friends at econ70.com. This is the Bowtie Economist. During 2022, the Dow slipped 8.8% and the S&P 500 index fell 19.4%, while the Nasdaq tumbled 33.1%. Among the 11 sectors in the S&P 500, energy gained a stunning 59% in 2022. No other sectors rose. Although some came close, utilities only fell 1%. Consumer staples like soup eased 3%, healthcare dropped 4%, and industrial shed 7%. The other 6 sectors fell over 10%, led by communications down 40%.